Monday morning, good morning. I'm Guy Johnson alongside Valerie Tytel. We're now an hour away from the opening trade. So what do you need to know? President Trump expects a, quote, big cut from the Federal Reserve. Will he get 25 or will he get 50? Weak Chinese data raising hopes once again that Beijing will deliver economic stimulus. We'll talk about that story in a moment. And French bond futures weaken after Friday's Fitch downgrade. How stable is the outlook in Paris, really, Val?
Well, starting off Monday on a positive note, S&P futures in the green, Eurostoxx 50 futures in the green as well. Eurodollar at 117.30, flat on the session, but big questions ahead about this dovish pivot from the Fed. Just how dovish will it be? Will it keep the dollar declines on track and this Treasury rally continuing? The countdown to the opening trade starts right now.
You have a big cut because I don't think he can help but cutting. It's perfect for cutting.
It's perfect for cutting. Does that mean 25, or does that actually mean that we're going to see a 50 basis point cut coming through from the Federal Reserve? Increasingly, it feels like Trump's Fed. What impact is that going to have? Who's going to be making the decisions this week? Who's going to be sitting around the table? There are many unanswered questions, but it's a big week for central banks. 25 or 50?
Big week for central banks. 25 or 50 is a question. The market is still entertaining the chance that they do go more than the standard 25 basis point rate reduction. However, you're getting calls from the street about this dovish shift. Not many calling for 50 this week, but many, like Morgan Stanley, calling for a consecutive pace of rate cuts, with Morgan Stanley saying the Fed aims to reach neutral decisively. They amped up their Fed calls late on Friday, now calling for 4 consecutive rate reductions, and they see the terminal rate south of 3%.
So why are we cutting, I think, is the key question here. Is it because actually we can and because the Trump administration wants us to, or is it because we're worried about what is happening with the economic outlook at the moment? We're worried about the labour market. I ask this question because I think it frames how asset prices are likely to respond to this. At the moment, the view seems to be Fed cuts good for asset price inflation. But ultimately, is there a subtext here?
Well, and also we get the summary of economic projections from the Fed. Are we going to see a collapse in this argument that tariff-induced inflation is going to come at the later half of the year, beginning of next year? I'm really interested to see how Stephen Myron is going to vote and where his dot is going to be on this dot plot. Is he going to vote at all? His Senate confirmation hearing is later this evening, but with the House Republicans, Senate tabling it for tonight, it's basically, for me, a vote of confidence that this vote will go forward, and he will be seated tomorrow morning at this 2-day Fed decision. But really, how far out of consensus is he going to be on his projections, and is that going to rattle the market around Fed independence?
And Cook?
Lisa Cook, the interesting thing around this is that the lawyers from both sides filed fresh arguments over the weekend, and Trump is pushing for the court to judge on her allowance to stay on as governor while the court is weighing the merits of the case. So he could have an update from the appeals court before the Fed decision on Wednesday.
It's amazing, isn't it?
Musical chairs.
Like musical chairs, twists and turns. Nobody's quite sure what we're going to get. 25 feels like the base case. But there's a few stories around it. I just wonder what the press conference looks like as well. Let's talk about what is happening with the China story. There's a couple of angles on this, one of which is that we need to talk about what is happening between China and the United States and the talks there. We'll talk about the data in just a second as well. But we've had these talks going on over the weekend. Seems to be some sort of a focus here on what is happening with TikTok, but it looks like TikTok's future and the deadline in the United States is going to be punted down the road. So you've basically got Bessent, Jameson Greer's there as well. You've got a high-level Chinese delegation on the ground as well in Madrid. The talks are going to carry on. Is this building up to a Trump-Xi meeting in October, I think, is the key question. Because my read of the situation this morning is actually there's a lot of really complicated factors that need to be resolved here before you get to such a summit. And there is this danger that China feels like it's got the upper hand, and we're seeing that in some of the chip investigations that have been announced over the last 24 hours as well. But what I've read over the weekend seems to suggest that China thinks it's got the upper hand, which means I think it's going to be really tough to get that Trump-Xi summit nailed down. And you want to have it nailed down a few weeks in advance. And we're not there yet.
Well, it's only 6 weeks away, which I think is the big thing. This assumed meeting where President Trump is going to be in South Korea for an APAC meeting. Maybe that face-to-face will happen. Maybe it won't. But only 6 weeks to go.
Yep.
They really need some progress this week in order for that meeting to go forward. We heard from President Trump. He said that these negotiations are going fine. We know that trade issues have been a big part of this, even though the deadline isn't until November 10th. Also things about national security after what you raised is this tit for tat over the chip investigations that comes after the White House announced more entities onto its restriction list, citing national security and foreign policy interests.
It feels like it's getting more complicated, not less complicated, and more difficult to get this nailed down. I wonder how the market would signal no summit, because expectations are growing about a summit. If you get no summit, what does that tell us maybe about the divergence of the direction of travel that we're ultimately going to see here between China and the United States? That's beginning to show up in the data as well. The Chinese data overnight, poor. Retail sales, particularly poor.
Slowing across the board when it came to industrial production, that missed. Retail sales missed. Also fixed investment missed as well, with some of these data points showing the worst month yet this year. And this is where these negotiations going on in Madrid can play directly into what's going on in the Chinese economy. These tariffs between the two nations are currently high. And if we don't get any breakthrough, these tariffs have a potential to stay in for a very long time, if not for various administrations to come. But interestingly, that the equity market, at least in Asia, didn't react negatively to this. We also saw the Asia Pacific Index, the MSCI Asia Pacific Index, trade above record closing highs after this data.
But it's exactly the same as what we're seeing in the United States.
Bad news is good news.
Well, yeah, precisely. Bad news is good. So, well, no, but also the AI trade is on. And I think that's a big feature of the landscape increasingly in China. And that is a mirror of what we're seeing in the United States as well. Economic data not particularly great at the moment. So the risk of recession is growing, I admit, from a low level, but it's there. The Fed's going to react to that data. But the AI trade, that underlying AI trade, is what keeps the train on the track.
Well, when it comes to those chip investigations that China announced, this is just another move which is seen by the market to protect their own homegrown chip industry. So we saw the likes of some of their the internal onshore chip companies rise in the Asia trade.
OK, we're going to come back to all of this in just a moment. Eric Nelson's going to be joining us, head of G10 FX strategy at Wells Fargo. Amy Gao is going to be here as well. We'll talk China, we'll talk metals, we'll talk mining, what is happening there. The strategist from Morgan Stanley. Ben Gutteridge, Invesco portfolio manager. And then Janet Henry, HSBC's chief global economist, will be joining us a little later on in the programme to set up all of the economic events that we have on the agenda.
Let's get you set up for your trading week ahead. Many of risk events on the horizon. Lots of central bank decisions, but it kicks off today. We have those U.S.-China talks continuing in Madrid. Tomorrow is probably the biggest economic data print of the week. We have U.S. retail sales. Remember, that's a direct feed into GDP for the third quarter. And then on Wednesday, we have the Federal Reserve rate decision and Trump's state visit to the U.K. Thursday, the Bank of England rate decision. Friday, the Bank of Japan rate decision. So 4 of the 7 G7 nations deciding policy. The Bank of Canada kicks it off, likely to be a rate cut on Wednesday. The Fed, I think, obviously is going to be the big driver, just how big the dovish shift is, what kind of message do they give in their summary of economic projections. And then later in the week, we got the Bank of Japan and the Bank of England, both of those central banks not expected to move on policy until the beginning of next year.
Yes and no for the Bank of England. So, yes, not expected to deliver a rate cut this week, but potentially a change in the way that QT is working. And that could have quite significant implications for the gilt markets. Remember, the gilt market's been under pressure, and also for the Chancellor, Rachel Reeves. So if gilt sales halt, it potentially creates a $4 billion hole, an even bigger $4 billion, well, a $4 billion hole in the budget that she is going to have to resolve, which is obviously bigger than anticipated. That number wasn't factored into original thinking. So if the bank changes its QT story this week, there's going to be a ripple into the fiscal. So no change to the Bank of England on rates, but potentially a change when it comes to gilt purchases.
Well, it could be an interesting week for the gilt market, for the UK market, because we also have UK CPI. We have UK labour market data. I know it didn't make it into our week ahead preview, frankly, because so busy with central bank policy decisions. But it could be a pivotal week for maybe not how the Bank of England acts on Thursday, but how they intend to conduct policy in the moving months.
And you've got the Trump wildcard to throw into the mix as well, which could make life very interesting. OK, what else you need to know this Monday morning? President Donald Trump has threatened to call a national emergency and federalize Washington, D.C. in response to the city's decision to no longer cooperate with ICE, i.e. the deportation story in removing and relocating undocumented immigrants. This according to a Truth Social post. The Commander-in-Chief has taken the drastic measure of deploying the National Guard to the capital last month. Remember, in order to combat crime, the emergency declaration allowing him to seize control of the police expired last week, but the National Guard deployment won't end now until November. Moving to Europe, the far-right Alternative for Germany party tripled support in municipal elections in the industrial state of North Rhine-Westphalia. The result intensifies pressure on Chancellor Friedrich Merz's government to revive growth and deliver on spending plans. According to preliminary results, the anti-migration AfD party increased its share of the vote by 9.4 percentage points to 14.5, while Merz's Christian Democrats received 33% of the vote. And over in France, French 10-year bond futures have drifted a little lower. This as traders have reacted to Fitch ratings downgrade of the country to A+ from AA- due to the rising government debt and increasingly political polarisation that we are seeing, which is raising doubts about the fiscal outlook. This as France's new Prime Minister, Sébastien Lecornu, dropped plans to cut 2 public holidays but warned the government will need to find other ways to cut its budget deficit. The interesting thing about the French decision, which I don't think comes as a massive surprise, is the outlook stable. And I just wonder whether the bond market this morning is kind of questioning that outlook stable story, that actually we have found a new plateau. And I'm wondering whether or not the situation gets kind of worse from here. We've got more ratings downgrades potentially coming down the pike towards us, I think in sort of October, I think it's November actually. Does France have a stable outlook right now?
Well, I thought it was interesting when it comes to the Fitch's decision, their projections of the deficit, they expect it to remain above 5% for 2026 and 2027. It's already around 5.4, the widest in the euro area. It doesn't sound stable to me. But essentially, their main point from their decision is there's no clear horizon for debt stabilization, given the weakness of the current government.
So how have they come out with a stable outlook?
Well, they can't. They want to go. They want to go slowly, I guess. They don't tend to. They tend to want to give warnings before they move. So perhaps this is just maybe they gave the warning in the agreement. They said that their outlook is stable, but maybe they potentially are going to be moving further if no progress on the debt stabilization is reached. And clearly, from their decision, it doesn't sound like they think they're going to.
You read it, and you're like, this doesn't sound stable at all. And that's the bit that kind of made me wonder. And I wonder whether the market is also signalling that this morning. Anyway.
Well, there was a great piece out from the FT this weekend that showed that the average working age income in France is less that of a pensioner.
Yep. The UK's got a similar problem as well. Both countries, I think there was another, maybe in the same piece, talking about the fact that basically France and the UK are enthralled to their pensioners. And at some point that will have to change. But obviously the politics around that are incredibly difficult.
It's a pension plan with a whole country,
with a country attached to it.
Instead of the airline attached joke they used to make about BA. Well, coming up on the show, we'll check on the impact of weak Chinese data on European luxury stocks at the open. Plus, Scott Bessent heads to the UK after Madrid while Donald Trump lands here on Tuesday. We'll take a look at the U.S.-UK relations. Up next, markets gear up for a Fed cut. We'll preview this week's crucial central bank decisions and others.
OK, before we head to break, HBO Max's new medical show, The Pitt, took home the Emmy Award for the Best Drama, while the studio on Apple TV won the Best Comedy. Warner Brothers Discovery, which owns HBO Max, the streaming platform, also saw Noah Weil win the Best Actor in the drama for his work on The Pitt. Overall, streaming platforms dominated the Emmys last night, the TV industry's highest honour, reflecting the continued shift from broadcast and cable to online viewing. We're still here. This is Bloomberg. 42 minutes to the equity market open this Monday morning. A couple of things you need to know, one of which is we've got details now coming through of the Orsted rights issue. The subscription price is 66.6 Danish kroner. There's a subscription ratio of 15 to 7. Let me just explain that briefly. Each of the company's existing shareholders, this is a quote, will be allocated 15 preemptive rights for each one existing share. So you get 15 preemptive rights for one share that you own. The subscription ratio of offering a 15 to 7 means that 7 preemptive rights will entitle the holder to subscribe to one new share. So you're getting 15 preemptive for every share you currently hold. Kind of sounds like a 2-to-1 ratio, which I guess is what the 15 to 7 kind of ultimately signals if you boil it down. Anyway, that's worth explaining. Val, the Fed, 25 or 50?
25 or 50, and what are they going to tell us in their summary of economic projections? Just how dovish is this Fed shift going to be when it comes on Wednesday? I thought it was very interesting. We're continuing to get economists across the street change their calls, boosting for more Fed cuts to come. Morgan Stanley out with a big revision, calling now for 4 consecutive rate reductions. They are seeing the Fed is going to eagerly want to get towards neutral towards the second half of this year. And their guidance for the terminal rate, they're holding south of 3%, and that is exactly what the market is pricing at the moment. The implied terminal rate in the market is at 2.95%, so south of 3%, which is important, Guy, because that is what the Fed tells us is neutral. So the market is saying we're going to neutral. We just don't know how quick we are going to move. It could all be down to the voters who are present at this decision this week. We still have questions on the air when it comes to Lisa Cook. The lawyers from both sides on her lawsuit presented new arguments on allowing her to stay on as governor while the courts weigh up the merit of her case. So we could have an update from Lisa Cook before the Fed decision on Wednesday. Also, Stephen Myron, this is Trump's pick to fill that open Fed governor seat. The confirmation is due to take place later today. It could be very interesting to see how he votes and how far his dot is from the consensus in the summary of economic projections. But it's not just the Fed that meets this week, even though it is going to be the pivotal one. We also have the Bank of Canada meeting on Wednesday alongside the Federal Reserve, and then later in the week we have the Bank of England on Thursday, and we have the Bank of Japan on Friday. These both central banks are not expected to move on policy rates until the beginning of next year. Guy?
Great stuff, Val. OK, let's talk to Eric Nelson, head of G10 FX strategy at Wells Fargo. Eric, thanks for joining the show. You buying or selling the dollar into the Fed?
We're inclined, Guy, to sell the dollar here versus the euro. I think what's sort of key here is this is a pivotal week for euro dollar. We've thrown a lot at this sort of broad dollar, whether it's Fed independence concerns, weaker U.S. data, lower U.S. rates, and really this is the key point where euro dollar needs to break out higher here. So that's kind of where we lean. I do think, though, if we don't break out on what we expect to be a relatively dovish Fed, then tactically we could be looking to kind of sort of go the other way because, again, if we have a dovish Fed on top of all the other dollar negative stuff we've had in the past few weeks and we don't break out, people are going to get frustrated. And I think vol is going to increase and people are going to start wondering, hey, do we need to actually rethink this, come back to this in a few weeks because it's just not working.
What would cause a breakout and why would there not be a breakout?
Well, I think if the messaging is, if it's 25 and the messaging is neutral or not as dovish as markets are expecting, then I think that would not cause a breakout, right? I mean, we've priced in a couple cuts already. I do think though that the sort of messaging, looking at the dots, for example, so we've got the dots going down to about 75 basis points this year and 50 basis points next year, which is not necessarily too different from where the market is, but I think the messaging it would be relatively dovish, certainly versus where we were a couple weeks ago, and in light of where we are in inflation, I think that tells you a lot about where the Fed's concerns are here. The key for me is that the Fed cutting this much in the face of, I'd say, rising or at least stable U.S. inflation, that's pretty dollar negative in a time like this.
Eric, you mentioned that you think the Fed will be relatively dovish, changing their dot plot to reflect 3 rate reductions into the end of the year. Do you think they'll give any further guidance when it comes to next year, or do you think we'll hear from Powell himself talking about going to neutral?
I do think that Powell and maybe more on the committee are also more in this camp now that Waller has been staking out for quite a while of, we want to get back to neutral. And, probably sooner rather than later. I don't know that they're going to be more explicit about 2026, but I do think that the Waller sort of line here on neutral is gaining a little bit more traction internally. So I'm not as concerned about the vote split per se. I mean, you might have one or two dissents, but I think what's key for me really is that messaging around getting back to neutral and doing so relatively quickly.
And assuming that Stephen Myron is confirmed later tonight by the Senate vote, do you think he'll be an outlier when it comes to the SEP, when it comes to his forecast, or is he necessarily not want to hit the ground running with that kind of tone?
I could see him being an outlier. I guess the question is, does it really matter for the market, especially if you see a number in there where it's clearly a new entrant and on the dovish side? I think people will say, okay, that's Myron, the known quantity, fine. I think what really matters is where the median ends up, where the average dot ends up. It's not going to get dragged down the average by just one vote, meaningfully. So I think people are going to be very focused on where the median policymaker is here more than anything else.
Eric, just to come back to euro dollar, how much is that going to be influenced by what is happening in France right now? We had the Fitch downgrade. We've got a stable outlook. We were just talking about how stable the outlook really is. Is that a factor to maybe keep a lid on euro dollar?
There already was a decent amount of premium priced into French bonds. I think that's faded a little bit. I don't know if you necessarily need to price in that much more premium here. I think what's key for me is if you see S&P and Moody's kind of move the same direction, we get below the AA notch for all three of the majors, that becomes more concerning. I don't know that we're going to get there. I think the key for me is, what's happening in terms of the 2027 presidential election. That's just too far off, I think, to matter. And frankly, France has done a decent job of fiscal consolidation this year, all things considered. So I don't know that it really matters that much at this stage.
Okay, all things considered appears to be the maybe key phrase there. Eric, the Bank of England is not expected to cut rates this week, but we may see a shift in QT. Is that... I'm trying to work out whether that's pound positive or pound negative. It's obviously going to maybe make life a little easier in the bond market, but on the other hand, is going to open up the hole that the Chancellor Rachel Reeves has to fill. Positive or negative?
For the QT sort of decision, one, I'd say that it's already sort of mostly expected that they're going to potentially dial back QT. I think if they don't do it, it may be even more of a surprise. And at that point, I'd probably lean toward pound positive. I mean, it's, all things equal, a tightening of monetary policy versus expectations. I do think the rates, though, matter way more than what the QT is doing. And there, I think the sterling has definitely come under pressure. Everyone sort of loves to be negative on sterling, and I think that's reflected in positioning. So I think the currency can do okay here. I think rates and the rates market themselves, there's more risk of lower moves rather than higher moves.
Well, Eric, do you see any needle being changed into the Bank of England decision, given we have CPI on Wednesday and tomorrow we have the labor market data?
Yeah, CPI is critical. We know from listening to Pill and listening to, frankly, a lot of the policymakers, they're focused on spot inflation. Now, you can take quibble with that or not, but that's what they're worried about. They're not looking at wages so much or labor market slack. So if CPI moves one way or another, I think you're going to see maybe actually markets sort of front-run the BOE decision. And given how many cuts have been priced out on the rate side, again, I think there's sort of more risk of a move lower rather than higher in UK rates at this juncture.
All right, that was Eric Nelson, the head of G10 FX strategy at Wells Fargo, with his thoughts on the FX market. And I thought it was an interesting point to end on. We don't know what's next for the Bank of England. The market is kind of tossed in between whether it's a hike or a cut when it comes to next year's policy rate. But coming up on China's broad economic slowdown raises expectations of stimulus measures. We'll dive into what it all means for the metals market next. This is Bloomberg.
30 minutes to go until the start of European trade. You got a fairly mixed picture, nothing doing. There was an interesting piece this morning in the Journal talking about the fact that equity markets are basically pricing in for the idea that the economy is going to be run hot, that we are going to see that kind of a narrative developing. But equity futures not really telling us that picture this morning. US futures largely becalmed, European futures fairly mixed. The FTSE looks a little soft, but nothing doing. No kind of clear sense of direction this morning.
Well, at least there is a clear sense of direction when it comes to European fixed income, and that is a continued widening of the French-German 10-year spread. We're seeing about a 2 basis point widening move. This is on the back of Fitch's downgrade at the end of the session on Friday. Those France 10-year yields are trading in line with their Italian counterparts.
Let's take you to Spain and figure out what is happening there. US and Chinese delegations are set to resume talks in Madrid later today after a first day of meetings covered issues including trade, the fate of TikTok, and a few other issues on the agenda as well. President Trump says the talks are, quote, going fine, but that TikTok's fate will be determined by Beijing's actions.
They're negotiating TikTok right now. We may let it die, or we may, I don't know, it depends, up to China. It doesn't matter too much. I'd like to do it for the kids. They like it. I mean, selfishly speaking, I did very well on TikTok, and I got the youth vote.
Still important, apparently, to the president, but it feels like it's becoming a little less important. I can't quite believe that, given the magnitude of what is going on, that we're worrying about what is happening with the social media platform, but it still seems to be taking the headlines and still seems to be relatively important. But they are struggling to make progress, and maybe that's why we're talking about TikTok, because progress isn't being made elsewhere. So maybe we look over here rather than looking at where things aren't happening, which is on trade.
And maybe if there is some sort of small progress on TikTok, they can hang their hat that they are coming closer to other economic agreements. And remember, it's just 6 weeks to go until this thought of meeting between Xi and Trump to take place in South Korea. So there isn't really a huge amount of time to be setting up that kind of negotiation. But trade issues obviously being paramount. The deadline for that, though, isn't until November 10th. So there isn't necessarily a lot of pressure when it comes to the wider tariff discussion.
The White House seems to play reasonably fast and loose with summits, though. And I do wonder whether, from a US perspective, 6 weeks actually is a relatively long time. I suspect from the Chinese point of view, different picture.
Yeah, that's right. But the talks yesterday lasted for 6 hours. They're beginning again today. The actual Chinese delegation is in Madrid until Wednesday. So we still could have a few more days of discussions between these counterparts before they split up and Bessent comes to the UK for Trump's state visit. But let's stick on China. Their economic activity slowed more than expected across the board in August, adding to the likelihood that policymakers will roll out more stimulus. Industrial output and consumption had their worst month yet this year after a sharp slowdown in July. Well, let's bring this conversation to our commodities guest, Amy Gower, metals and mining commodity strategist at Morgan Stanley. What did you make of the Chinese data overnight? Does it change your view on such assets like iron ore?
So I think we had already been expecting a bit of a slowdown in the second half of the year in China, just because particularly things like their trade-in policy domestically, that tends to run out of steam the longer it goes on. We obviously had very good data to start the year. So a slowdown, I think, would be expected. But obviously when the data does come through weak, that does start to raise questions. I think the key thing here will be, does China then follow this up with stimulus? And sometimes what we can see is then the iron ore market starts to get excited in anticipation. And in fact, we've already seen this in recent months, even around anti-involution and hope there. That has actually driven iron ore prices higher, even if actually for demand that hasn't been so positive.
Well, would it be anything out of these U.S.-China talks that could maybe, I guess, move these conversations for stimulus even more so onto the agenda if perhaps it's just more clear that there is not going to be any progress on trade for the next few months? That would be maybe a sign of urgency to the Chinese government?
Yeah, I think that could definitely be a factor. I think, we know that for China, the export market is important. So whether that's to the US or elsewhere, what we've seen in many things like steel, they've been manufacturing more than they need, but exporting that. Air conditioners, solar panels as well. So if they lose that export market, they're going to have to focus on doing more at home. So I think that should be a key consideration. And also these 3-month extensions are quite challenging with these trade talks because shipping distances and timing takes quite long. So if you only have 3 months visibility, that doesn't give you opportunity to make full use of that.
How much would a Xi-Trump summit provide a kind of moment of clarity? Like, how is that on your radar screen as being some significant event for the commodities market?
I think clarity is a strong word at the moment. We're struggling to get visibility on things happening. I think certainly if we were to see positive engagement and what looked like a trade deal, that would be helpful. I would also say, though, China has proved to be very good at pivoting and finding new markets for its products. So even without the US, they are still managing to maintain this manufacture and export model.
How are you feeling about gold into the Fed decision?
So I think gold finally has the catalyst that was perhaps missing for the last 4 or 5 months, where we saw it trade pretty much sideways. We've seen all the physical demand still good. ETFs on track for record inflows this year outside of 2020. Central banks still buying at record levels. But now we have the Fed cutting. What we tend to see on average at the start of a rate cutting cycle, gold moves up around 6% on average in the 60 days after the first cut. So I think should be a positive catalyst, both in terms of ETF inflows, dollar movement. So I think, still bullish on gold here. 3,800 is our year-end target.
3,800 year-end target for gold. I have a question, though. How much of that year-end target is really going to be driven by worries of Fed independence, or maybe worries that the Fed is going to be too dovish with its monetary policy? Is it easy to parse that out aside from the physical demand story of central banks?
Yeah, I think it's a difficult one to split out. It obviously, I guess, it raises more interest in gold as an asset and drives those inflows. I mean, we have already been seeing those ETF inflows all year. And then I think it's going to drive perhaps also more investor positioning across the futures market as well. But I think it's really going to be about monetary policy, and then also if these physical demand can hold up. And jewelry is one area where we are seeing some offsetting weakness. And I think if we do see another big move higher, that's often where jewelry demand can react even more so.
How sticky are people's gold holdings this time versus previous cycles? So I've been through plenty of economic cycles. You get a downdraft, people sell what they can. Gold has, in a number of situations, been that thing which they sell. Like, it's slightly counterintuitive. You think it would be a safe haven, but actually it's liquid and easy to get rid of. This time feels slightly different. As much as people are buying gold for different reasons, there's central bank buying, which has been driven by de-dollarization, by the risks around what happens with US action to seize and hold assets. Is the gold market set up differently this time round?
Yeah, look, I think we haven't really seen central banks selling gold in large quantities since sort of the 2000s.
Yeah, Gordon Brown.
And so it's been more of a shift towards buying. I think we heard from Poland in the last few days that they're currently at 22% of their assets in gold. They want that to be 30%, so they're still very much going. China's still adding steadily. So I think central banks are still very much adding. ETFs, we can see, as you say, those outflows, and we do tend to see that when stock markets move down or even up and people want to take advantage, they sell their gold first. Usually that's a buying opportunity. So I do feel like that is quite sticky. And then, look, we are seeing a bit more recycling. So perhaps if you're buying jewelry, you're selling something old and buying something new again. So we are seeing that, but probably not meaningfully enough to shift the price.
Amy, is this outlook based on the relationship between gold and the dollar still being an inverse relationship? You said you have around a 4% rise in gold targeted for the end of the year. What kind of dollar decline would that entail?
Yeah, so our FX team is forecasting the DXY to get towards 91 by the second quarter of next year. So some of that will potentially through the end of this year. That is in alignment with the gold price that we forecast. And that relationship very much holds. You have to remember gold is expensive, but any dollar weakness can make non-US dollar holders, it can make the gold price a little bit cheaper for them.
Am I buying gold or am I buying something else in the complex at the moment?
Gold is still top pick.
Still the right trade? Not silver, not platinum, not any of the other precious metals?
Silver has been slightly outperforming on and off. I think what we would say on silver is that solar has been a big end-use demand for gold, and that is starting to slow, particularly in China. So that might ease off a little bit of the demand, but I think, look, they're both probably going to do well. Silver actually tends to rise about 4% after a Fed rate cut versus gold at 6%. So silver does actually tend to lag a little bit.
Great to see you. Thanks for stopping by to see us this morning. Emmy, metals and mining commodities strategist, joining us from Morgan Stanley. Let's talk about another angle on the China story that we're watching also very carefully this morning. China has launched 2 investigations targeting US the US semiconductor sector. The Ministry of Commerce opened an anti-dumping probe relating to certain American-made analog IC chips. We'll explain what an IC chip is in just a moment. And an anti-discrimination investigation into US moves against the Chinese chip sector. Tom McKenzie is the person to ask about all of this and has zipped over to join us. Good morning.
Good morning, Guy.
You can tell when Tom's talking about tech, he takes his tie off. Let's talk. So, how significant are these Chinese probes?
So I think it's a reminder that, number one, China over the last few years has been giving itself the policy tools to be able to respond to the US. It's a reminder that from China's perspective, when the US takes actions, they will take a countermeasure. And, of course, it gives them leverage as they start and continue these talks in Madrid with the US. It's also a reminder that in the domestic chip-making story for China, building out their own domestic chip champions is central to their longer-term policy. Whatever happens in the conversations with the US over the next few days, weeks, months, even years, the longer-term trajectory is a China that wants to be sovereign when it comes to its own domestic chip production. On a number of fronts, they're still a long ways from that, but when it comes to ICs or integrated circuits, particularly the analog integrated circuits made by the likes of Texas Instruments, that is not a pain point necessarily for China. They have domestic players who can compete and build out those kind of chips.
How would this tit for tat evolve? So China's moved for launch these two new investigations. Is the U.S. likely to respond, given that Bessent and Helifeng are in Madrid currently discussing these topics, or is that something that is going to be needing to be shelved?
So how much does President Trump want? How much does he want that sit down with Xi Jinping?
I
think if you answer that question, and all indications seem to suggest that the US president does want to sit down with his Chinese counterpart, and they're trying to lay the groundwork for that. Look, the US could still respond. The US could still take this badly. The US has a lot of tools at its disposal. It could rethink its decision to allow the likes of NVIDIA and AMD to sell their more sophisticated chips into the Chinese market, the H20, if they give that 15% of sales. That decision came through, of course, and we're still waiting to see how that's implemented on the ground. They could rethink that. They could pull back on that. They've got other levers. But does that come on the back of these talks? I mean, certainly something to watch for, but the sense you get is this is a US president who wants to sit down with his Chinese counterpart, and the sense is the Chinese understand that as well. So now, their anti-discriminatory move was in response to talking of the US tools and their disposal, was in response to a US decision to put 23 additional Chinese companies on the so-called entity list for national security reasons.
But this was the thing that we were debating a little bit earlier on, which is why am I reading lots of stuff about the fact that the Chinese feel that they've got the upper hand in these negotiations? Because if you look at the economic data, it doesn't tell that narrative. It tells a completely different narrative. US economy booming, maybe slowing down a little bit, but the Chinese economy looking really in a tough place at the moment. But maybe that explains the answer to that question and why people are writing about this, because actually Trump wants the meeting and the Chinese know that and will play that card. Is that the only reason? Why else would the Chinese feel they have the upper hand here?
I think the other part of it is that, yes, the real estate market of China is underwater. Yes, the retail and the consumer is under pressure. But if you look at the tech space of China, if you look at the inflows into tech equities, if you look at the AI momentum in China, and if you look at the achievements that the semiconductor industry of China has made, then there's confidence there at a policy level and executive level amongst those companies that, in fact, they are gaining and making significant gains, and that they therefore have some leverage on that front.
Great stuff, Tom. Thank you very much indeed. Tyler's Tom McKenzie joining us around the table this morning. Coming up, UBS apparently is considering a potential move to the United States in response to new capital requirements being imposed by Swiss regulators. We're going to talk about that and all the other stocks you need to watch next. This is Bloomberg. Twelve minutes to the equity market open this Monday morning. I've been trying to come up with a kind of neat phrase. Rate cut week doesn't sound very exciting. Central bank week doesn't sound very exciting either. I think we need a new something to make it sound a little bit sort of jazzier. But it's a big
dovish
week.
Fed pivot week, perhaps?
Let's call it that. That's what we're going with. Run it hot week. That's what the journal seems to be going with this morning. A fascinating article this morning. I can't come up with anything. But that's what it's about. But it's not really rate cut week, though, is it? The Fed is dominating, and it feels like rate cut week because that's all we're talking about. Bank of England probably unlikely to move. Got the Bank of Canada, got the Bank of Japan.
Awkward central bank decision week?
Let's go with that.
When it comes to the Fed rate decision, I mean, you might have the new entrant Myron sitting there. You might have this allegation hanging over Lisa Cook. It could set up to be quite an awkward.
I think he kind of walks in and there's like silence in the room as he kind of comes in and sits down. Do you think they chat? I don't know.
Oh, to be a fly on the wall.
How polite it would be.
And Waller sitting there maybe with the crown. You know, Wall Street Journal talking about who he is the dark horse in the Fed chair race last week. So, yeah.
Rick Reeder got a lot of attention this weekend. A lot of attention this weekend in terms of if he was chair, what policy would mean. Much more sort of creativity maybe at the central bank. So, yeah, I think it's, awkward meeting. I'd love to be a fly on the wall. Anyway, let's talk about what else we're going to be watching. The story this morning maybe actually is that we're not seeing much reaction in French assets. You had the downgrade as expected, you could argue, largely by Fitch. They've kept it stable, which actually, to my mind, is the more interesting story. Ven Ram, as ever, writing about these things on Markets Live. Let's get his take on all of this. I'm slightly questioning the outlook stable bit, Ven, but it does seem as if we kind of got what we expected and we can fade the move that we've seen in French bonds. Is that really the narrative here?
Morning, Guy. Yes, I think that is the denouement here. I think the downgrade was a long time in the making. You've got deficit that is running well above 5%. And Fitch said over the weekend that they expect that to stay that way next year as well. And if you look at the debt to GDP of France and the deficit, both are running at nearly twice the EU mandated levels. The EU wants them pegged back to 3%. But we are not going to get to 3% anytime soon. So France has been trading at a discount to Italy and Greece, and both our nations rated several rungs below France. So the bad news, you could argue, guys, is already largely priced in, which is why you're seeing a muted reaction at the start. And the silver lining in all this, as you mentioned, is that Fitch has pegged the rating outlook at stable, which means that they don't expect a change over the course of the next year. And with all its problems, France is still trading is an A+ debt. And I think that, investors are going to take heart from there. And the point is, it's not that French bonds are going to rally from here. It is that they are going to trade with a mild risk premium, but that's about it.
Ven, when it comes to the Fed decision on Wednesday, what's the key thing you're watching for?
Well, I think that they've got an easy part and a tough part. The easy part is what everyone expects, the 25 basis points rate cut done and dusted, I think. But the tough part is what they really do with the dot plot. And they indicated 3 rate cuts to 2026 in June, Kriti. So now the markets are already moved beyond that. The markets are saying 6 rate cuts by the end of 2026. So the Fed will have a challenge in pegging the markets where it wants to be. And of course, this all comes in a context where if you look at inflation swaps, the markets are pricing in 3.5% inflation or thereabouts in the next 1 year. So it's not going to be an easy thing for the Fed to be cutting rates when inflation expectations are so elevated over the short term.
Where does the volatility come from this week, Ven? The Fed looks like we're going to get 25, but 50 maybe would deliver some of that. We'll wait and see. Is it from the Bank of England? Maybe, maybe not. Where do you see volatility emerging from this week?
I think that, a lot of volatility should be expected from the Bank of Japan because on the one hand, we had the trade uncertainty that is removed now. And I think that, we have signs that the next incumbent for the Prime Minister's post could be someone who is fiscally dovish. And that sets up the Bank of Japan to be raising rates. And if they kind of drag their foot on raising rates, I think that the markets won't like that, and you will see a lot of volatility coming from JGB yields spiraling, and that is not a good message for the rest of the global markets, the rest of the global bond markets, especially the gilts.
All right, Bank of Japan still one to watch on Friday. Thanks to Bloomberg's Ven Ram for your thoughts on the market. Now let's get your stocks to watch ahead of the European Equity Open with Chloe Melly. Chloe.
Start with French stocks today after Fitch downgraded France's credit rating after, of course, all of the political turmoil that we have seen over the last few months in the country. There are some key sectors and companies to be thinking about. So banks, of course, like BNP, SocGen, Crédit Agricole as well, insurers like AXA, and then also more domestically exposed stocks like Vinci, for example, the toll road operator. Those sorts of sectors and companies are exposed to public spending and to bonds. The CAC 40 has been underperforming the Stocks Europe 600 as we can see here, and that gap has been widening. So definitely a country-specific story to keep an eye on today. Moving on to UBS, where we could see some movement here as well today on the back of one of the top shareholders saying that the new capital requirements in Switzerland would make it maybe impossible for UBS to stay in Switzerland, and that it would have to either leave it or be acquired by a competitor. So we could see some movement this morning in the shares of UBS that have been having a really good year so far. And finally, let's talk about Campari. Summer is over, but let's talk about Aperol Spritz one more time. Campari was upgraded to a sector perform rating by RBC that noted a very sensible strategy, and that should be quite encouraging for a stock that has a majority of buys and holds and very few sells at the moment. So quite encouraging for Campari this morning.
Clay, thank you very much indeed. One more Aperol Spritz, maybe. OK. Coming up, it is time for the opening trade. Futures are a little bit positive, but not by much, fairly mixed, I would argue, here in Europe. We are waiting for the big central bank decisions to come through. That is going to dominate the agenda. There's a few corporate stories on the agenda as well. Anyway, we'll talk about it all in just a moment. We've got 5 minutes to go until the equity markets are going to be opening. Are we going to see any kind of impact into French stocks as well this morning? Looks like that story's been largely priced in. But keep an eye on the banks today. There's a BVA story, there's a UBS story. It's been a central part of the European equity market story over the last few weeks and months. Are we going to see some change today, maybe on some of that narrative? We'll talk about it next. The market open is coming up. This is Bloomberg. Monday morning, how are you feeling? Big week coming up. Central banks are going to be dominating the agenda. Equity markets on tenterhooks, waiting to see whether the Fed delivers 25 or 50. The legacy from Friday looks a little bit like this. European equity markets kind of went out near session lows, actually, in terms of the US session, which then rallied and then became a little choppy towards the end of the session. I think there's a little bit of positivity still needing to be priced in out of Friday into Monday for European equities. This is what futures look like. It looks like maybe the French equity story is brushing off the downgrade. I think that was largely priced in. The outlook is reasonably stable from Fitch looking forward for French equities. Eurostoxx 50 futures are now up by 0.5%. The FTSE's absolutely flat. Now, keep an eye on what is happening with the mining stock story, the oil story. We're going to talk about the luxury story as well when it comes to China as well. The DAX is up by around 0.5% this morning, so a little bit of underperformance from the FTSE. DAX looks reasonably positive. Continental markets looking a little bit more positive than UK markets right now. So that's the kind of picture we find ourselves with. Not a convincing start to the week, but there's so much about to happen. You can kind of understand why, Val.
Well, let's take a look at some of the sectors and individual stocks we'll have our eye on this morning. Let's start it there with French stocks generally at the back of this Fitch downgrade, but especially French luxury stocks on the back of the disappointing China data overnight. It had their big miss in retail sales, the weakest data point of the year so far for that metric. Also, keep an eye on UBS. Supposedly, they are weighing some strategy options, as reported by the New York Post, that they have met with U.S. officials to discuss a potential move to the U.S. following new Swiss regulations. And lastly, an eye on Orsted. This is the wind energy developer who announced that their rights issue is going to be priced at a 67% discount. Guy?
OK, let's see how all this trades into the market this morning. It is time to get this week underway. Here we go. Time for the opening trade. Let me show you some numbers. Remember, a little bit of underperformance expected from the FTSE 100. We are up by less than 0.1%. But the Spanish market, with a firm eye on what is happening with the bank takeover story out of that market, BVA, etc., Sabadell in focus. Stock 600 is up by 0.2%. We're expecting that to climb a little bit. The CAC 40 is expected to be up. The DAX is expected to be up by around 0.4%. It may take a while. I'm interested to see how UBS trades first thing this morning on the back of all of these stories that we're watching. Might be a quiet open, actually, on the DAX. The DAX sometimes takes a while to get going. This morning it hasn't. We're up by circa 0.3. Let's call it 0.4. Let's call it 0.3%. It's maybe underperforming a little bit what futures were telling us. But a positive start, Val, to the stock story this Monday morning for Europe into a busy week. What are we looking like on the sector front?
A positive start on the sector picture as well. We've got banks at the top of the basket so far this morning. morning. We have all but two sectors in the green. We have got healthcare and telecom currently in the red, but banks, basic resources, travel and leisure leading the storm in the first few minutes of trade. I'm looking for any weakness in luxury stocks. I actually don't see it, but when it comes to retail, there's a French retailer at the top of the basket when it comes to the biggest mover on the session on the back of an upgrade from the street. So it does seem to be some of these French names are showing a bit of resiliency to the Fitch downgrade on Friday.
It's interesting. AstraZeneca is a little bit soft. A lot of talk over the weekend. You were flagging as well about its relationship with the UK, keeping that story in focus. Some of the defence names are a little bit soft, not by much. SAP is acting as a little bit of a drag to the downside, but you've also got that being countered by ASML, which is on the upside. In fact, from a points point of view, ASML is the biggest gainer today. There's some positive news from Novo Nordisk in terms of the dosing around its weight loss drugs, and UBS is up by 1.21%, the fourth biggest points gainer on the stock 600 this morning. LVMH not too far behind, which is interesting.
French luxury doing pretty well. Remember, we had an eye on this, maybe some weakness on the back of the disappointing Chinese activity data overnight, but it does seem like LVMH is performing very well, almost up 1% so far in the beginning of trade. Hermes is one of the biggest movers as well, up 1% on the stocks 600. So it does seem to be like, again, this theme of French assets really being resilient to what's going on in France. Even BNP Paribas, one of the biggest gainers so far this morning.
The luxury names kind of make sense on that front. They are not exposed to France. They are exposed to China and the US, and we're going to get retail sales out of the US a little bit later on tomorrow, I think. So I'm not sure that luxury is a French trade. Definitely a China trade, though.
Well, let's bring in Ben Gutteridge, sitting around the table with us this morning, portfolio manager at Invesco. Thanks for sharing your time with us on Monday. I hear you're cautiously bullish this market. What would make you very bullish this market?
Well, I mean, yeah, I guess that sort of cautiously optimistic is one of the most overused phrases in asset management investment. I think it sort of hinges upon a Goldilocks type backdrop, which might seem a bit cavalier because the growth numbers are looking a bit challenged with the US jobs data clearly getting weaker, but that the resilience of the jobs market still positive, coupled with lower rates on the back of less inflation, is enough to keep me positive. I wouldn't get into the sort of like wildly positive, but positive enough.
Well, when it comes to this rotation out of U.S. equities, more into international equities, something that Europe has benefited from a lot this year, do you see that as a continuing theme into year-end, especially as this chorus about worries of Fed independence seems to grow?
Well, I think, I think on balance, it wouldn't be into year end. It's hard to sort of bang the table too much, especially this nice bit of equipment you got here. But
leave it alone.
I think on a sort of 12, 18 month view, we'd be positive about that rotation. And actually, within your question, sort of the gradual sort of politicisation of some US institutions doesn't encourage us to favour the dollar, along with other concerns as well. So, feeling more positive about the euro and European growth. Leaves us encouraged to support the rotation out of US equities into European equities. Not at a startling rate, but certainly a gradual rotation.
Europe outperformed at the beginning of the year.
Yeah.
Now gone flat. Is that going to change?
Well, as I said, it's hard to sort of call over the short term, but we believe, yes, it would. We believe the outperformance of international equities, European equities, will return on a sort of 12 to 18-month view. As I say, the dollar's going to play its role in that. Maybe valuations will play a role, but, of course, that's been an argument long-trailed and never really sort of done enough. But I think with the European banking sector in such sort of great health and European consumers, actually unemployment very, very low, if not record lows, and starting to borrow a little bit more, banks starting to lend a bit more. I still think there's sort of and of course the fiscal story, certainly out of Germany, I still think it's an underappreciated story, and so we do support the rotation. Timing difficult, but we support the rotation.
There's this whole narrative that the Americans want to run their economy hot. They want growth. They don't want growth, push it up, keep it going. That's certainly the Trump administration's view at the moment. And I'm wondering why you would invest outside the United States in that kind of environment. Let's cut rates, let's juice the fiscal story, let's go. And that seems to be a call that I'm hearing a lot at the moment. Why would I not want to be part of that and be part of the European story, which seems a little bit more meh?
Well, look, I mean, I get it, and I have a lot of sympathy with those arguments, and it makes a lot of sense. And indeed, sort of local currency, dollar-denominated share price movements could be really helpful. I don't think it's a bad news story for the equity story if there is a bit of politicisation and maybe there is this sort of juicing of the economy, but it doesn't sort of tell a good story, I don't think, for the sort of the bond market or certainly the dollar, and that could have an impact on the total return an investor enjoys. Right. You know, the US equities versus European equities.
Well, when it comes to what you just mentioned about having an adverse reaction in the bond market, that's really what a lot of those who are bullish to the equity market are worried about. We're seeing yields a spike above 5%, but we have rallied decently from that right now with 30-year yields trading at 470. How are you thinking about the curve steepening trade? Is that something that really plays into your decision-making, your calls on how the curve's going to trade going forward?
Well, sort of worried about how many people are calling for curve steepeners, but find it hard to argue against that. You know, I think there is clearly or seemingly a commitment to cutting rates at the Federal Reserve. Obviously, we'll get more news on that this week and communications thereafter, but the short end looks like it's, you know, moving lower. And, of course, then you have this sort of debt sustainability, Fed independence, still maybe some inflationary challenges that sort of keep the long end sort of supported or you know, at least elevated. So probably looking a bit more consensus on that one. But, yeah, think curve steepeners are probably the right trade to have on in that part of the market.
With that frame in mind, are you thinking that the dovish shift from the Fed on Wednesday could be more than the market expects?
Well, no, I'm not, actually. I mean, I think you're going to see a lot more tension in the Federal Reserve. That's what we're sort of anticipating. In that, you know, no doubt there is a sort of general commitment to easing rates now. I think that line has been crossed. But it's I think sort of the chair would be more of the cautious disposition, wanting to move gradually, whereas you have more in the there's certainly some Waller and such who want to move more aggressively, and you know, I think the tension in the Fed will create will prevent it becoming across as overtly dovish or recklessly dovish, I think.
Still buying the dip, right?
Well, I think so, yeah. I mean,
you don't sound massively convinced about that.
Yeah, I don't know. It just sort of feels like a lazy call and someone who doesn't do much research. And maybe that is partly true, but no, I just think, you know, with growth, I think with growth resilience and, you know, a Fed cutting cycle, you know, it's just, I think that is a supportive backdrop for equities.
Are clients okay buying the dip? What are they what are the questions you're getting at the moment? And are they changing in any discernible fashion?
Well, I mean, I think clients are generally sort of on balance of a nervous disposition at any time in the cycle.
Yeah, okay.
And here we are there, the market's been running quite hot and the jobs numbers have been very weak. But, you know, we contextualise that in what it might mean for the Fed moves and then the markets might be able to look through the valley of sort of weaker economic data, foreseeing even better...
Sunlands.
Yeah, all of that. Long-term investment, of course,
I mean,
sensible strategy.
Are any of your clients or are you feeling nervous about the AI trade at the moment? Are you bullish on that, given the government's involvement, at least in the US?
Well, I mean, always nervous. I mean, goodness me, I'm going to sound recklessly bullish across the whole spectrum here. Yeah. But as I said, I do support the rotation into European equities, but think like the earnings story does support sort of loftier valuations in the AI space. I mean, the investment, the CapEx programs are sort of incredible, really, which, of course, some is some spending for others and therefore should be like a hit to earnings. But the return on investment that businesses are getting, some of these hyperscalers, you know, in terms of client engagement, advertisers, accruals from the AI element to their business plan, I think the earnings story isn't about to collapse. Valuations look rich, but I just think they can stay elevated.
Do you not worry that
no,
they've got to make money? You never worry. Don't worry. Just don't worry about it. It's going to be fine. There is... you've got to make money off it. And you look at what OpenAI is doing right now, it is struggling. It's spending a lot of money, but it's struggling to generate a big return off it at the moment, commensurate with the scale of the investment that is happening. You're old enough, you've seen a few investment cycles go around. Do we always see some winnowing? Do all of the players always win? Do we see maybe some falling by the wayside? Is that a process we need to go through to actually cement the AI trade and make it actually something that does have maybe a little longer that can have a longer-term impact. Not everybody's going to win. When does that process start to unfold, and how do investors react to it?
Well, I mean, as you say, yeah, I mean, sort of the picks and shovels, the infrastructure players that sort of lay the groundwork for these various stages of technological sort of revolution don't typically end up being the winners. But I still think we're sort of quite early, despite the level of investment in the AI sort of infrastructure. It's not obvious how much, like, consumers are getting out of AI. There's certainly, perhaps there's gradual sort of month on month, year on year. Businesses certainly doing reasonably well out of AI. But I mean, you look at sort of AWS, Amazon, the Meta and Alphabet return on investment in AI. It still looks really, really encouraging for them. So no, there will be there will be winners that we haven't sort of forecast that really capture the service element of AI. Difficult to forecast, but for now, I still think like those sort of mega caps like are reasonably well supported and a very reasonable thing to have in portfolios.
Okay, well, we took the mickey when he sat down. I would say he hasn't got a tie on, so we definitely had to get him to talk about tech a little bit. Ben, nice to see you.
And you both.
Ben Grusarich, Portfolio Manager at Invesco. Core 6 looks like this morning. What are we watching in terms of the moves that we are seeing on the screens? As you can see, tech's quite mixed, actually. SAP's a little softer, but ASML is certainly on the front foot this morning. Schneider's a little bit mixed as well. That's kind of the picks and shovels story around the AI narrative too. Rheinmetall's up, making a transaction in the naval space. LVMH, that's the one I was going to watch out for this morning. Looking okay. A on the French front and B on the luxury front. It is, and we're going to talk about this in a moment, it is also Fashion Month. So you've got New York Fashion Week going on this week, then it goes to London, Milan, then Paris. That's all important stuff. And we're going to be talking to Andrea Felstead in just a moment. Let's talk more about the moves that we're seeing. Chloe Mellis, here with the details of those.
Good morning, guys. Let's start with maybe a bit of a niche stock this morning, Rubis. Rubis is a French fuel retailer, and it is up this morning 6.7% on the back of reports that it is said to be receiving bids by Trafigura and also CVC Capital. It has been under a little bit of pressure from some shareholders to move away from investments in solar power, and those potential bids are really driving up that stock this morning. Moving on to Brunello Cucinelli, which is in that luxury space. It was rated overweight at JP Morgan. That said that the growing high net worth segment, consumer segment, was really helping there, and that Brunello was a really important pure play in that sort of high-end ready-to-wear segment. So the stock is up 2.2% on the back of that. Moving on to Sainsbury's, where we've also seen some positive movement this morning. And Sainsbury's ended talks with JD.com over the sale of Argos. And although some analysts said that there was a strategic rationale for selling this particular unit, investors seem to be rewarding Sainsbury's for deciding not to go ahead with that sale, and it is up 3.8% on the back of that. Moving on to Saab, and there we have a down movement for Saab, the Swedish defence company, and that is over media reports that India will not be choosing its Gripen jet. So that is really weighing on the stock a little bit this morning. We are down 1.4%. And finally, Orsted, the rights issue is at a 67% discount, and that is dragging down the shares for Orsted as well this morning, down 3%. Yet another setback for a company that's been having a bit of a tough time recently.
Thanks to Chloe Mellis from our equities team on the movers. Just 14 minutes into today's trade here in Europe. We're also hearing from Scott Bessent and Jameson Greer over in Madrid, speaking to reporters. Bessent saying they're close to resolving the TikTok issue with China, but says if no TikTok agreement, it won't affect their overall relations. Bessent also saying their Chinese counterparts have an aggressive ask. I'm interested to hear what that is entailing. He said that after Bessent said that he had made good progress on technical details with China. So it's probably around these technical details that they're asking. We also heard from Jameson Greer saying they want to maintain a good relationship with the Chinese. It's something that obviously we'd heard from Tom McKenzie saying that they want to have this meeting have some sort of progress in order to help perhaps this bilateral meeting, a face-to-face meeting in 6 weeks' time in South Korea.
There's always been this expectation from President Trump that he can resolve things. You get me in the room with the opposite kind of person, I can fix that. The Chinese don't feel like they are that kind of... It's not that kind of conversation with the Chinese. It's interesting that Bessent's talking about Trump has great respect for Xi. kind of setting up the narrative. I have great respect for you. I want to get in the room with you. I want this meeting to take place. But the aggressive ask, the Chinese, that maybe reinforces the comment we were talking about earlier, which is that the Chinese feel they have the upper hand. They're making kind of, they're being pushy. They're not rolling over. There's no kind of easy fixes here, which makes me wonder about whether or not actually this goes ahead. If Trump feels he can't make progress in a one-on-one with Xi, does he take the meeting? Does he want the meeting? At the moment he does, because he thinks he can probably resolve some issues. But is that possible if the Chinese are feeling that they have the upper hand? Trump won't want to give stuff away in order to just make this meeting look good. Anyway, we'll talk more about what is happening with the Chinese-US relationship in just a moment. We're also going to talk about what the Chinese data tells us about what's happening with European luxury. Stocks are actually on the front foot this morning. The retail sales numbers out of China were, though, weak. We've got US retail sales coming up. It's New York Fashion Week, then it's London Fashion Week, then it's Milan Fashion Week, then it's Paris Fashion Week. We need to talk about all of this. We should probably throw in the Emmys as well, just for good measure. All of that coming up. This is Bloomberg. 19 minutes into the equity market session, this is what the picture looks like right now. A little, I would say there's actually surprising strength coming through from Europe this morning, which I think is interesting. Stock 600 is up by 0.3%, DAX is up by 0.3%, CAC is up by 0.6%. Actually, it's luxury names that are doing quite well there. FTSE, as expected, flat as a pancake this morning. But actually, the story this morning, in some ways, that does stand out is luxury doing really well, despite some weak Chinese data. We've got US retail sales data coming up. The market's on the front foot, likes the narrative.
Yeah, some of the biggest points gainers on the Eurostoxx 600 are luxury names. LVMH at the top there. We also are seeing other shares such as Kering, Hermes, and Richemont trade in the green to start this week's trade. But joining us now to discuss luxury and more is Bloomberg's Opinions retail and consumer goods columnist Andrea Felstead. Welcome to the set. It seems like this China slowdown, the miss in Chinese retail data, is not impacting retail stocks at the moment. What's the impact?
No, I mean, the sense has been that China isn't getting any worse. But you've got a bit of strength possibly coming through from the US. So that's why the luxury stocks have rebounded from their lows over the last few weeks.
In terms of the data that we're watching most carefully, so you've got Chinese data coming through. China, there was a time when the relationship between China retail sales and luxury was really strong. It feels like it's not as strong. But US retail sales, we're going to get tomorrow, feel like a really important data set.
Yes, exactly, because it's really... China has been on the back foot for a while now. It's really the US that's taken on the bling baton. You know, we've got equity markets. Yep. Recovering, Bitcoin up, exactly. That there's normally quite a strong correlation between that and luxury stocks. So the problem is when we had tariffs earlier in the worry about tariffs particularly earlier in the year, that's when luxury was really hammered because the idea was both of those growth engines were suffering at the same time. But it looks like apart from the weaker data today, China doesn't seem to be getting any worse. And the US could strengthen a bit, which is why a lot of investors are getting a bit more positive on luxury.
And we've had these fashion shows take place in New York. We're also moving to London and Milan in the coming weeks. Maybe investors are just more bullish by what they see on the catwalk.
Well, we've got to see what they come up with because we've had around at least a dozen designers changing jobs over the last 18 months to 2 years. That's absolutely unprecedented. And the hope is that particularly Milan and Paris are the big shows, that we're going to see some excitement out of the catwalks and must-have bags, which are very profitable, but also just this idea of re-engaging customers again. Part of the problem is, you know, greedflation, boredom. They didn't really have to, they were selling so much, they didn't really have to try very hard to create amazing products. And then consumers started to balk at the price increases, and then they thought, well, what are we even buying? So they need to, you know, work on two fronts, get some more accessible products, accessible price points, but really create excitement and create that desirability, which is the key to luxury sales.
I'm curious. So we had the Emmys last night. Catwalks versus red carpet, kind of which has a bigger impact?
They're all helpful. They're all helpful. The catwalk probably sets the direction, but then if you see someone in an amazing outfit or an amazing bag, then that can also get, you know, hearts racing if you're into bags and shoes. But really, it's all the same narrative. It's getting consumers interested in luxury again, really being fashion and luxury, being in the cultural zeitgeist. I mean, you've only got to switch on the TV and it's all cooking shows. When I was growing up, it was all fashion. We had the clothes show, and I know you've got Project Runway, but the whole culture has switched away from fashion to food. And we've really got to, you know, the industry has really got to engage customers again so that they put fashion ahead of experiences.
Andrea doesn't watch cooking shows, clearly. More clothes shows. Andrea, thank you very much indeed. Bloomberg Opinions, Andrea Felsted. Let's turn our attention to what is happening in the more industrial end of the market. The Danish offshore wind developer Orsted plans to sell new shares at a 67% discount after a bet on the US market has gone spectacularly wrong. Joining us now for more is Christian Weinberg in Copenhagen. Christian, this is a big discount. Is this what was expected? Talk us through what we've learned from the company this morning.
Well, it is a big discount, but it has to be a discount once you want to sell shares to the public and you're in a problematic situation. Now, Orsted obviously needs to convince investors to buy into this and participate. The good news for Orsted is that two of its biggest shareholders, the Danish state and Equinor, have said in advance that they would participate. So it's a good starting point, but it's really important for Orsted to not come out of this looking overly bad after all the problems they've faced.
And Christian, what's at stake for the wind developer with this rights issue this week?
Well, first of all, there's its image, right? You need to come out of this looking okay. You need to be able to show the market that investors backed up on this rights issue. In terms of the money, the banks are actually underwriting this rights issue, so Orsted is more or less guaranteed to get its $9 billion. But there's also another thing to look out for here during the process. There's a lot of speculation about consolidation in the wind energy industry. And if one of the current shareholders emerge from this rights issue having boosted their stake, or if there's a new investor coming in announcing that they've taken a stake, it's only going to add fuel to the fire on the speculation on consolidation.
All right, thanks to Bloomberg's Christian Weinberg in Copenhagen on the latest on Orsted. That's a good point. He ends on consolidation in the wind energy space. If one of these investors, he was just mentioning that a lot of the main shareholders are going to be a part of this rights issue, but perhaps we can have an activist investor on our hands after this rights issue takes place.
Or just a trade buyer coming in and saying, actually, we think at the price now that this is an opportunity that we can take forward. Some sort of combination might work. Yeah, I think it's going to be interesting to watch it from that point of view. We're going to be watching very carefully, of course, what happens next this week. Central banks absolutely front and centre. We've yet to come up with a catchy title for this week. We're going to work on that with Janet Henry. She is going to be joining us very shortly. Global Chief Economist at HSBC. Central Bank Week, that's not exciting. Rate cut week, is that true? I don't know. Janet's going to help us out. That's next. This is Bloomberg.
Welcome back to the opening trade. We're 30 minutes into today's session, and it is looking fairly positive, with one exception being the FTSE 100, just slightly in the red. That's off the back of AstraZeneca after they pulled some of their UK investment funding over the weekend. Eurostoxx 600 up 0.3%. Outperformance in the CAC 40 up 0.7% so far in this morning's trade. It's off the back of a decent trade in luxury. Also, some of those French banking names trading positively this morning, really shrugging off the Fitch's downgrade on Friday. Guy?
Let's talk about market internals and see where we are this Monday morning. Quietish start, you could argue. You can certainly see that in the volume metrics. We've changed the arithmetic a little bit here. 20-day average, we're down around 10% off the back of that, but 427 up, 151 down. This does feel like it's a market that is on the front foot. There aren't many 52-week lows. There are a few 52-week highs that are worth talking about as well. You've got Rubis. Actually, there's a couple of retailers. Rubis is up on the back that we may be seeing actually a takeout here coming through from private equity. Jay Sainsbury's on the Argos story It is up by 5%. The market's certainly giving a positive view on that. UBS, so we're going to be renaming UBS. The stock's up by 1.42%. Is it going to be the Union Bank of New York? There's talk in the New York Post that maybe actually there's been a conversation with authorities in New York about moving the bank. Feels like this is an early stage and could just be a negotiating tactic with Swiss authorities. But you've also had some fairly big shareholders out over the weekend talking about the fact that maybe it is inevitable that UBS does move out of Switzerland. Anyway, UBS up by 1.33%, Val.
Well, here's what else you need to know this morning. China's economic activity slowed more than expected across the board in August, increasing the odds that policymakers will roll out more stimulus to hit its growth goals. Government data shows industrial output and consumption had the worst month this year, while retail sales grew at a slower pace than the previous month. Fitch Ratings has downgraded France to A+ from AA-, citing the country's rising public debt and political instability. The rating cut takes France's credit assessment a notch lower than the UK's and on par with Belgium. Sitting just 6 levels above junk, Fitch's rating is now the lowest among its peers. And moving to the U.S., President Donald Trump maintains his pressure on the Federal Reserve. He said he expects a big cut from the central bank this week. Trump told reporters conditions are, quote, perfect for cutting. This is as investors weigh a 25 or 50 basis point rate cut from the Fed on Wednesday. Guy?
The meeting starts tomorrow, though. It's a 2-day meeting. Who's going to be at the meeting? If Mr. Myron is there, does he kind of walk in? He's not Mr. Dr. Myron. As he walks in, is there silence? Does everybody greet him warmly? How does it work? The Fed feels quite divided at the moment. Is Lisa Cook going to be there as well? These are key questions. Actually, the tone of the meeting could be really quite interesting and could be reflected, you could argue, in the dots that we are about to see. Is Myron's dot, if he's there, going to be significantly different to everybody else's? But is he going to be there? The Senate is due to vote on Stephen Myron's nomination to the Fed board. We think that's going to be late tonight. Of course, we are waiting for the Fed decision. Is he going to be there? Ros Matheson joins us now with more. Is he going to be there?
Well, quite possibly. We're expecting maybe a decision on that overnight. And as you say, maybe we now get that this evening. But all this is happening very, very quickly as the meeting is supposed to start
last minute.
Tomorrow at the last minute. I mean, you've got the moving parts of Myron, but you've also got Lisa Cook as well. And the question is, what does that do to the potential conversation in the meeting? I mean, the economic data, economists say, really do shift us towards a rate cut of 25 basis points this week. But you will get those voices arguing for 50 basis points. You may get others arguing to hold, saying, you know, that there are people who believe that we are still going to see an impact on inflation from tariffs at some point down the road. We're not seeing it necessarily now, but this is all going to come. You don't want to rush aggressively to cut in all of that. So the conversation in the meeting is going to be very interesting. If he's in the room, you've got a bunch of sort of chairs shifting around in all of this because Donald Trump is trying to reshape the Fed very much into an institution that he feels will be more willing to listen perhaps to where he thinks rates should be. That's part of his agenda as a whole across institutions in the US, not just the Fed, but also courts and elsewhere. And so do you get those kind of dissenting voices, not just at this meeting, but obviously at other meetings the rest of this year? Does it become more controversial as the rest of the year goes on and we see further economic data, and including around inflation? And what does that do around the messaging for the Fed? So the dissenting part of it's going to be very interesting.
And Roz, when it comes to this current lawsuit that Lisa Cook is facing, could we have a decision from the appeals court overturning the previous court's rule for her to stay on as governor?
Well, they're trying very hard in terms of the White House because right now there's an injunction that keeps her in place while her lawsuit against her firing goes ahead. There's another effort by the administration on the weekend to get that overturned so that she cannot attend that meeting. That's through the appeals court. If that's unsuccessful, do they dash to the Supreme Court later today to try and get something there? But, you know, time is running out. At this stage, it does look like the base case is more likely that she is sitting in on that meeting that starts tomorrow. You can't really pull her out halfway through. For example, if she's already starting the meeting. She went in saying that she's been preparing for the meeting. She's there to have the conversations around the economic outlook, around interest rates. She's trying not to let all of this distract her in part of that. But, you know, it's very hard to say what the courts are going to do today.
Ros, we're going to leave it there. Thank you very much indeed for setting us all up for us as we watch very carefully what is going to be happening at the Fed. Ros Matheson joining us ahead of that meeting, joining us to talk about this and all the other central banks that we need to focus on this week is Janet Henry, Chief Global Economist at HSBC. How divided do you think this meeting is going to be?
There will be differences of opinion. There always are. And remember, it was only at last month's meeting, well, 6 weeks ago, that it was the first time in many years that you'd had two people voting, dissenting, voting for rate cuts when the rest of the committee was on hold. As Ros just summarised, you could get a three-way divergence, something we've really only seen recently from the Bank of England, not the Federal Reserve. You could have a couple of members voting for no change, the majority voting for 25 basis point cuts, and probably at least three, if not more, voting possibly for 50 basis points of cuts. And that's what the markets care about, not the personnel changes, but what the vote is and how much divergence is shown, as we all know, in the dots and in the projections.
Is it just, it's going to be one of those meetings where dots go is the function you need to think about on your Bloomberg?
I think that's always the first thing that people look at. Previously, I think it will be, are there going to be two cuts or three cuts this year will be part of the key issue. And if you look what's priced into markets, by the end of next year, it's 140 basis points of rate cuts. It's probably going to be hard for the Fed to outdove what is already priced in to the markets. And I think that's what will matter for the currencies. But the initial thing is, are they going to say, yes, we are going to cut rates 3 times this year? And in particular, what do they do to their unemployment forecast within that? But, very divergent.
Well, Janet, when it comes to the unemployment forecast and perhaps what Powell says about neutral, we had Morgan Stanley amp up their calls saying the Fed is going to be more at an urgent pace to cut towards neutral. Is that something that Powell could explicitly tell us at this meeting on Wednesday?
Well, I think what Powell will be very clear at is remind us that the neutral rate is unobservable in real time, and different members of the committee have a different idea of exactly where it is. So some members think that policy is really quite restrictive. Others think that we are getting closer to neutral. And he will remind participants and all of the reporters that he's talking to that the Fed has a dual mandate, and they will do everything within their mandate to adhere to both parts of it, the unemployment rate and the inflation rate. At the moment, unemployment is tipping the balance. That is moving them towards getting to neutral a bit more swiftly. But then people will ask the question, if he mentions neutral, is neutral 3, is neutral 3.5, or is neutral 2? And I think the majority on the Fed think it does not have a 2 handle. It's what part of 3 to 4% range is the neutral rate. I think he will really step away from the idea of a point estimate of where the neutral rate is currently.
And when it comes to estimates of where the unemployment rate could possibly reach, last time around, their previous projections, they penciled in 4.5 by the end of the year. Is there a risk that number moves materially higher?
Not materially so. It could be a point estimate. But I think Powell, once again, will talk about not just the demand for workers, but the supply of workers. Because, if the participation rate is not going up, we obviously know what's happening on the immigration side. The labour force growth has slowed down quite markedly. And this is when you will get into all of those discussions about what do payrolls need to run at. And we know payrolls are being revised on a consistent basis at the moment. Where are we lying? So I think it will be one of those meetings where they will try to pin him down to the point estimates on unemployment rate, the point estimates on inflation. Don't forget that, on inflation. We are seeing more tariff impacts as well, and they will not get anything beyond what is in the official projections. And again, a bit like last month's meeting, basically say the dots are just the committee's best estimate at the time of where they're going.
Is Powell a lame duck? Who are you listening to? Who's the personality that is going to have the biggest impact you over the next 6 months?
I think markets listen to every member, in particular, of the Federal Reserve Board, the 7 members. Powell speaks for the committee. He will talk about the fact that the decision was not unanimous. Previously, he has exposed himself as one of the more dovish members of the committee. Remember, there are people that are a lot more hawkish. But I think at the moment, people are still listening to Powell. But going forward, it will be, already the dissenters, so Waller and Bowman, and of course, the newest member of the committee, Steve Merritt.
What else is going to move this week? do I care about the Bank of England? Is it going to change QT?
I think we do care about the Bank of England because the Bank of England, has been on a steady and gradual pace. It's been a quarter-point cut every quarter. And now we're getting to November, which would be the next quarter, and the market's not pricing it in, and very few people are now forecasting November. So it will be scrutinised. Again, what is the split? What is the divergence? We get back to the neutral rate question. There's definitely a couple of members on the MPC that think we are virtually at neutral. There are others that are going to be voting for rate cuts. So the market will be looking at the Bank of England. How long are they going to be on hold for? How hawkish are they going to be, even if the next move is going to be downwards? How long are they going to have to wait for that next rate cut?
Are they going to halt QT? Should they halt QT?
We are forecasting that they will keep the pace at reducing it by 100 billion. Absolutely, it's a very close call. Do they slow it down? Do they slow it down to 75 billion in terms of reducing, the QT holdings? But our forecast is that at this point they probably stay on hold because if you're keeping policy on hold because inflation expectations are showing some signs of being de-anchored, then they probably will not change QT at this point.
Well, how do you see the labour market weakness in the UK feeding into the inflation picture? As you mentioned, inflation expectations are elevated, services inflation is elevated. Were they likely not to worry about that because of what's going on in the labour market? We get updates on both this week.
We do. I mean, the inflation numbers have been pretty ugly in the UK, and we don't think they've peaked. We expect inflation over the next couple of months to rise above 4% in the UK. And that is a time when, as you say, inflation expectations are quite elevated. The private sector side of the economy, wage growth has actually been moderating, and we are looking for labour markets to slow down further. It's just that actually, when you look at the data at the moment, particularly the service sector data, some of it's been a little bit perkier, as our UK economists have been arguing. It has. The service sector PMI surprised on the upside. Some of the labour market surveys have not been so bad. It's all relative. And actually, that speaks to a pause at this point, even if the Bank of England, like ourselves, do expect inflation to slow over the course of next year, which is why we are still looking for rate cuts. We just don't think they'll probably cut again until the end of April next year.
Well, could expectations on the UK economy be even perkier if Trump and Starmer get some sort of investment decisions made during the state visit? Are you looking at that at all for economic indicators?
We look at everything. And remember, at the moment, globally, we're still talking about a lot of uncertainty. We don't know what policies that are coming out of the White House are going to be tomorrow or next week. And similarly, in the UK, we've got the uncertainty related to the budget, which will not be until November the 26th. So some of the influences from policy domestically, globally, that affects the man in the street, we're not going to know for some time. If you've got uncertainty, people don't take decisions on hiring, on spending, on investment. So I think, yes, good headlines, helpful for confidence, but are you going to act on it? If you've still got price pressures and cost pressures, I would be cautious about that. As I say, on the UK, some of the perkier surveys, they finally surprised for 1 month on the upside. We'll take that for now.
We'll take perky for now. Fitch says the outlook for France is stable. Is the outlook for France stable?
That's their adjective for using it. Yeah. What I would say is
how stable does France look to you economically at the moment?
France has a large budget deficit, and it has quite a large debt, not materially different from what we have in the UK or indeed the United States. But remember, France does have a lower interest rate than either the US or the UK. So the debt, if they manage to rein in the budget deficit at least a little bit, you can reach a kind of debt stabilising level of GDP. So I think where there is the cautious view of France is that they've typically struggled since the 1970s to ever run any kind of primary balance, and they will continue to see market participants and rating agencies watching looking for signs that that budget deficit is finally starting to narrow. And obviously, we are talking at a time of ongoing political uncertainty in France.
Yeah, and the widest budget deficit in the Eurozone for France. But we'll continue that conversation on France in just a moment. Thanks to Janet Henry, Global Chief Economist at HSBC, for joining us. Well, coming up, as promised, we'll watch the French bonds after Fitch downgraded the country's credit rating. We'll dive into the details of the rating decision next. This is Bloomberg.
.49 past the hour. Welcome back. You're watching the opening trade. This is what the picture looks like in Europe. Generally front foot equity trade. London's a little bit of a laggard today. The pharma space is under a little bit of pressure. AstraZeneca taking some points out of the FTSE. Let's talk about what is happening with the French market, though, which is definitely on the front foot. Maybe less related to what is happening with the downgrade and more to do with what is happening in the luxury space. French bonds, though, little kind of, that's where I think you are getting a bit of a sort of reaction that's worth talking about. Fitch rating, remember, Friday decided to downgrade the country but kept it stable. The outlook after the downgrade was on negative watch. This is France's new Prime Minister, Sébastien Lecornu, dropped plans to cut 2 public holidays but warned that the government will need to find other ways to reduce the budget deficit. Joining us now, Jean Dabard, economist at Bloomberg Economics, joining us from Paris. The outlook, Jean, is now stable, according to Fitch. Is the market signalling maybe that the outlook isn't that stable?
Well, we think that any risk of market sell-off would be limited and any market sell-off will be contained. First of all, because we think that the political premium is driving the spread, not the credit fundamentals at the moment. Second, we think that the downgrade was priced in by market participants. France is trading like a BBB and is even, and some big French corporates are even trading below France. And finally, because the French macro backdrop is holding off pretty well at the moment, despite all the political noise. And we think that the main risk for France would be the medium-term rating outlook, and especially if there is a convergence in ratings with Italy and Spain.
When it comes to the potential cuts from the new Prime Minister, when it comes to trying to get this deficit more in line with the EU target, is there anything you think he's going to take target at that maybe would be a bit easier for the government to absorb?
Well, first of all, I would say that the Fitch downgrade would put a lot of pressure on the government and on its ability to strike a deal with the centre-left, which is the key party to watch for the next budget talks at Parliament. And all in all, we think the next government will have to make some concessions to the left. First of all, it should need to reduce the size of the fiscal plan from 44 billion euros to maybe 30 billion euros. That's the first concession we expect. And the second one would be to find a new way or to agree with the centre-left on some sort of taxation of ultra-rich citizens. And all of that we need to be done in very short deadlines, because the new budget law will need to be presented to Parliament in early October. And in the background, we will have a lot of rating agencies lining up for new rating events for France.
All right, that was Jean Dalbard, economist at Bloomberg Economics, keeping us up to speed with the situation in France. Let's also turn to what's going on here in the UK. Scott Bessent heads to the UK after Madrid, while Donald Trump is back in Britain for a rare second state visit. For Prime Minister Keir Starmer, the royal welcome could bring a brief political breather for UK politics. For more, we're joined by Ruth David, head of our London bureau chief. Thanks for joining us this morning. What's at stake for Starmer and Trump this week?
There's so much at stake for Starmer. He's coming out of a really difficult week. I think both the US and the UK have kind of put a bit of breadcrumbs around. The banks are investing more. You know, they're going to be hiring more. The financial firms are making a big push into the UK. There's this nuclear partnership that they're talking up. They're talking about NVIDIA and OpenAI doing more investments here. But I think the bigger question is this press conference that both leaders give. they are going to be asked about Mandelson and his links to Jeffrey Epstein. And we are also coming at it in the backdrop of this real controversy around free speech. 150,000 people in London were protesting this weekend, numbers far more than we expected. And you have Elon Musk talking about the UK government needs to change, and you know, some really incendiary comments were being made. And how is Starmer going to be dealing with all of that?
How big, the risk of the press conference, how big is it for Starmer? How wrong could this go for Starmer? We're looking at the pictures over the weekend. He's had a really tough last few days. Questions are being asked about his leadership. How well does this trip need to go for Starmer for that not to accelerate at this point?
And before Mandelson was fired, it seemed to be going well, right? Because the tech deals that were signed up, there's talk that Mandelson was the architect of it. It is a huge coup to have him here. But obviously the press is going to be asking about Epstein. And remember, President Trump has some connections there.
Yeah.
And they're going to be talking about free speech. And President Trump and Starmer have some slightly different views on that. Though Elon Musk is now out of favor with the US government, arguably, so maybe Starmer can call him out for the comments that he made.
How significant is this Astra story? They're 200 million, Cambridge headquarters, the money's not going to go there. This is part of a trend. Astra's been, and other pharmaceutical companies have been basically saying the UK doesn't spend enough on drugs, therefore we're not going to invest enough. How significant is this as a story?
Yes. I mean, and the last price talks on drug pricing rebates fell through. That stalemate was really disappointing.
Yeah.
Astra comes on the heels of Merck saying that they're going to pull their $1 billion investment. You are hearing of other pharma companies, just this general drip feed of discontent. In yours, you're seeing it in, I mean, not just that UK companies are not announcing big new investments into the country, they're pulling existing investments. I think that is something that absolutely the Prime Minister, and remember the Chancellor, who's talking about this big budget where she wants to get money from God knows where, because there isn't that much money, and she has her fiscal deficit that she needs to take into consideration. It is a huge blow. But then we hear that the Prime Minister is going to be hosting GSK and Microsoft and some other CEOs when Donald Trump visits. So maybe there will be slightly more investments, but Astra is definitely a thorn in their side.
OK, Astra currently down by just over 3% in this morning's market, the biggest points drag on the FTSE 100 as well.
Well, let's get you set up for your trading week. A lot of risk events on the horizon. Continuing today is the U.S.-China talks in Madrid. On Tuesday, the biggest economic data point of the week, arguably U.S. retail sales. Wednesday, the Fed rate decision, the biggest one of the week, but there are still many more. Wednesday is also the Trump state visit to the U.K. Kicks off with the state dinner with the king that evening. Thursday, Bank of England rate decision, and it doesn't end there. Bank of Japan rate decision also on Friday.
Fed's the main focus. Bank of England, its vote splits look like they're going to be the surprise.
Yeah, just how much on the same page are all of these global central banks, especially when it comes to the Fed, because we still don't know who potentially is voting in this decision on Wednesday.
We don't know who's going to be voting. We don't know how they're going to vote. We're not sure whether or not we could have a three-way split. Janet Henry was talking about that just a moment ago. You can see a similar thing in the Bank of England as well. So significant divergence. There's a lack of clarity maybe within central banks about where policy goes next. Stephen Mirren's going to be joining us a little bit later on. We've got a key vote coming up for his temporary nomination to the Fed a little bit later on. That's a key conversation. Looking forward to that. The polls is next. This is Bloomberg.